another episode of Policy and Profits. I'm EJ Antoni. I like to play an economist on TV, but more importantly, as always, joined by the one, the only Anthony Esposito, trader extraordinaire, Wall Street legend, founder, CEO, Ascalon 6 Capital, knows about all things markets. So we are obviously going to be picking his brain like crazy today on what's going on with yields, what's going on with the S&P. Anthony, before we get into all that, how are you doing today?
I'm doing great today. We've had a really crazy day. Some of the realizations, some reality kind of hitting home a bit with the market, but we're doing well. We actually have come up to our recent levels, and I'll talk about it quickly. And EJ, thank you so much for the introduction, my friend. We talked last week on the chart as far as the front month E-minis, the S&P 500 contracts, getting up towards 7,500, maybe 7,550. And if you were to pull out your chart yesterday on a euphoric end to the recent part of the rally, not an end to the rally, I'm saying just on the recent peak, which was yesterday, we actually hit a high of 7,540. So right in the fat part of our range, that kind of culminated with a trip to, or was the last day of a trip to China with Trump and the administration. We had a massive Cerberus semiconductor IPO, which was priced at 185 and opened at 390, closed the day today at 300. So we had a big tech IPO, which is a full calendar for the year. We had a trip to China where Trump and Xi were going to work out some massive economic plans and deals and kind of straighten the relationship and move forward. That's all good. And then we headed into a pretty turbulent market today where we saw some significant drawdowns on the S&P and the Russell. So doing well, market finally coming in. The AI story is there. I want to talk to you about that today, actually. AI story is intact, semi story intact, but there are some things that no one's talking about, and I think that we should discuss. As I am not a perma bear, but I do love to hate them. I'll make money either way, but I do love to hate them. How are you? That was a long-winded answer, but how are you? How's the week? How's DC? How's the swamp?
I am hanging in for a swamp. Yeah, it is what it is, right? Another busy week of travel. I think I have something crazy, something like 4 weeks in a row with 3 cities each week. So this past week was in Manhattan a couple of days, so seeing folks up there, talking to different hosts in the business world, also talking to a number of big players on in the trading space. So really good meetings on that front, getting the sharing ideas, have different people who have their finger on the pulse of these issues, being able to hear from them and to, again, just share ideas and share knowledge and everything, try to come up with some more comprehensive views, I guess you could say, some more comprehensive takes in terms of what's going on. The data can sometimes tell you a lot of really conflicting narratives. And so getting all these different perspectives, I think, helps you tell a story with that data that maybe fits more of those different datum points than if you just tried to come up with something on your own. So again, really good to talk with all of those folks. One example, I guess you could say, in terms of that is if you look at the manufacturing industry, and by some metrics, manufacturing is booming right now. And then you look at some other metrics and it looks like the industry is just hemorrhaging. So what's going on? I think a lot of it comes down to the Iran war. There has been a total scramble, very similar actually to what we saw during COVID when you started getting shortages. Total scramble to try to get as much stuff in the door as possible. So yeah, there's been a surge in new orders, but it's not like a one-to-one increase in terms of output. In other words, we're seeing a lot of stockpiling. And you're seeing that increase in new orders at a time when prices are going through the roof. Usually you see the opposite, but it's because if we look at the outlook side of things, people are anticipating even higher prices in the near future. So again, the goal is get as much raw material in the door as possible right now. And then when prices are higher in the future, you don't have to buy as much, and it'll be easier to pass along your costs to people further down the supply chain. So again, really interesting dynamics there where by some metrics, it looks like activity in the sector's really, really hot. And then by other metrics, it looks like it's really cooling down. But getting all these different people's perspective at different levels in the supply chain, again, I think helps tell a more comprehensive story.
That's great. That's great stuff. There's definitely many sides to the story, and it brings to light and reminds me of this AI story, this tech story. So we have a market which has really exploded off of the lows. We were down at the lows in the E-minis. We were down at the 6,400 level, which, by the way, was a target of ours back in February, which is absolutely fantastic. We're happy to have gotten there. And then the rally's been nothing short of tremendous. We've actually gotten, I guess at this point, peak to trough, we rallied about 20%, let's say, from the lows in in March, excuse me. So we've had this massive rally, very, very similar to the rally back coming out of Russia, Ukraine, and that 20% bear that we had in 21, 22, where AI all of a sudden became the story. And everyone started to talk about NVIDIA, and everyone started to pump money in. This is really that story, I would say, on steroids, but that would be an understatement. The moves, whether it's percentage above 50-day moving averages, whether it's percentage of earnings that are attributable only to Mag 7, whether it's percentage of whether it's breadth numbers or volume numbers, or everything is really leaning to a very, very narrow rally and a very inflated, basically manic hyperbolic rally in the semiconductors and in the AI related names. One thing that people are not talking about is the debt underneath this, at what I consider to be a growing equity bubble. And if you look at valuations and you look at the run, you have to admit, whether you think that bubble will last or not, you have to admit that this is definitely bubblicious. There's no question. I mean, I'm listening to pundits and supposed experts on TV, actually, because I have to have it on or else I wouldn't, actually say, I know it's a bubble, I know it ends really badly, but you got to be on board. Like, that's not good advice. That's not sound advice. But if we look away from the equities and we start to talk a little bit about the debt that's being issued, I found some interesting charts. You and I were looking at them earlier in the week. The first chart we have is the hyperscaler bond sales, which were up massively last year. The amber part of these bars is the actual bond sales in the U.S. So if you look at 2020 through 2024, you're looking at somewhere between 40 billion in bond sales and 20 billion in bond sales each year. 2025, that number spiked up to almost 90 billion, and they started to go out internationally. So you can see the top of that bar getting us up to 100 billion internationally. This year alone, we've issued 100 billion in over 100 billion actually in U.S. bond sales. And we've gone up on another 40 billion internationally. So issuing those sales in Asia and in Europe. And then we have a forecasted issue that brings us well above $160 billion just for this year. So there's a massive amount of debt here. I don't know that people realize how much debt is actually being written underneath this equity bubble to support this growth and this CapEx for AI. And I don't believe that, although the internet is still in place as it was in 1999 and 2000, the bubble that was created, the exuberance in the market over it, was clearly way, way, way over its skis. I have to think that issuance like this, and now global issuance like this, is they're way, way over their skis. Do you agree with me, or am I just being a Debbie Downer and I should say they should issue as much debt as possible and grow as fast as possible, because there is no limit to AI and the semiconductor power and expected cash flows and earnings from this?
Anthony, if this was if we were still in that ultra low interest rate environment, I think you'd have a stronger case to make for justifying all this debt. But you're not seeing corporations float this debt at a fraction of a percent in terms of annual yield here. This is expensive financing that we're talking about, at least relative to a few years ago. It's very expensive, right? And on top of that, again, this is really, we're basically selling people a big bag of hope. This feels a lot like the corporate version of buy now, pay later, which is another debt problem, consumer level, obviously, but it's another debt problem that we're getting increasingly fearful is going to start rearing its ugly head, in part because of the lack of regulation. It's not that the regulation would make it safe or anything like that, but it's simply that there's no reporting standards here, so we don't know how much is out there. We do know the quality is terrible. We just don't know the quantity. I mean, when people are having to put groceries on these different credit schemes, like you know that's got to be pretty desperate people, and so this is not high quality debt. These are not 800 FICO scores, let's say.
Yeah.
That being said, you can look at these companies that are taking on all this debt and say, well, if we want to talk about kind of the corporate equivalent of the personal credit score, these are considered really valuable companies. These are considered well-established companies, et cetera. And I get all of that. I don't dispute that. These are, companies that maybe not today, but in years past have had very solid earnings. But here's the issue. It's the sheer size at this point, the sheer quantity of debt that's being issued. I agree 100%. This is incredibly concerning.
Yeah. Yeah. When you look at, and my question would be, when you look at the valuations of the companies and you look at the amount of debt being issued, what if the model's off by 5%? What if the model's off by 10%? How does that affect the market cap? How does that affect the names? How does that affect the paper that's written? I mean, these are massive numbers, massive numbers. You talk about rates. Today there was a lot of pressure on top of the market today. The market chose to completely ignore rates as it does. They're going to ignore the problem until they don't ignore the problem. It's not a problem until it is a problem. The 10-year today at 4.596. The 2-year is at 4.077 as we speak. And the 30-year, I believe, is at a 30-year high at 5.12%. Like this is a problem. This is a problem. Now, I know President Trump has a reputation of not wanting the rate to go above 4%, 4.1% on the 10-year. That's fine. But at some point, the market becomes bigger than anything the government can do or any kind of direction from the government, the Treasury, the Fed. Like the market is the gorilla in the room. And when the market decides it's moving. And on a global basis, rates are going higher. And I said this a couple of weeks ago on an interview, rates are going higher. And they are because the market's pushing them higher based on growth and based on inflation expectations, which is a problem. And I think will become a bigger problem here, as you alluded to. If we look at, what is the future expectation? We have a second chart, which is the value of the data centers that are not, the leases that are not yet started. So these are data center leases from Oracle, Microsoft, Amazon, Meta, Google, CoreWeave, reaching in 2025 Q3 almost $600 billion in leases that are not yet even started. I personally spoke to a friend 2 days ago who was talking about construction of the data centers, and he's involved on the investment side, the capital market side. And he actually told me that these companies are basically saying, build it as fast as you can. We don't care what it costs. We just need it done. The only thing stopping us from making money is the fact that the data center is not built. That to me is manic. It's insane. So they're sitting on, these companies, these 6 companies are sitting on almost $600 billion of leases for data centers that are not yet even started. That to me it's not reasonable.
Yeah, and it's really scary, Anthony, too, in terms of, again, is this debt actually going to get repaid? Half of the data centers in these different projects that were started on January 1 have now either been paused or canceled. Now, that has to do with higher energy prices and all that stemming from the Iran war. And so once those energy prices come back down, there's a good chance you see all this stuff, restarted or whatever the case may be. But it speaks to the leverage problem here, right? And something that you said earlier, how much of this actually needs to go bad, right? But before the whole thing comes down, we should remember that back during the mortgage meltdown, you weren't talking about MBS where, like half of the mortgages stopped being paid. It was never anywhere near that bad. In fact, even in a lot of the, what should have been labeled as a junk bond, even in a lot of those situations, you weren't seeing like half of these mortgages stop being paid. The problem is this: if you're going to take a loss on a mortgage, oftentimes it's not just a matter of you lose out on those coupon payments, it's you lose out on the principal too.
Yeah.
And so, again, this is not simply a matter of, well, you need catastrophic losses across the board. No, you need a relatively small percentage of these loans to go bad. And those losses are enough to wipe out the gains from all the other assets in that bond. And now all of a sudden you have a financial instrument with zero yield. I mean,
Yeah.
that's essentially, and then it doesn't take much more for the yield to turn negative, right? That's what you're looking at here, unfortunately, with a lot of this debt. So again, going back to that point you raised, which I think is a great one, it's not going to take some kind of catastrophic series of losses where all of these data centers go bust or whatever to cause real financial problems.
Yeah, no, it won't. And I think people really, it's amazing to me. I'm gonna skew for 1 second. The experience and the time and the tenure of most people trading the markets now is not it's not war tested, meaning or battle
Mm-hmm.
tested, meaning most of the PMs, most of the traders are they just haven't been through a real bear market. They haven't experienced what we did experience in the 90s, in 2000, in 2008. Maybe they heard about the COVID shock. Maybe they were just starting. Maybe they were there and it was a market shock. It wasn't really a bear market.
Right.
That's fine. But they really haven't experienced something like the credit crisis in 08, 07, 08, 09. And I think the experience there and the experience in 2000 is something that would serve them well. And I say that because there is this constant buy the dip mentality out there. Everyone, including the retail investors, are buy the dip. We are literally, and I'm fine with it, but we're living in a casino. There is very little investing being done on the fringe. It used to be that it was a market of investors and thoughtfulness and funds, and now and on the fringe were psychotic kind of gamblers and traders, and that's fine. But I kind of feel like we inverted that model now, where the core of it is psychotic, and it's a free for all, and on the fringe are investors and long onlys and due diligence. I just don't see that. And everyone I speak to and everything I see on the screen suggests to me that that's the case. Now, you could make the case that I am part of that mania. We're a top-down long-short fund. We're technically driven. We're in a very small basket of futures, and I am not a holder of assets. I don't invest in anything where I'm going to hold it for 6 months, 12 months, 5 years. What I'm trying to do is take advantage of dislocations between price, trend, and momentum and make money on my trades. If I feel as though the S&P is poised to move higher and it has some momentum and it's intact with trend and it matches our model and our signal's positive, I'll be long it. I might be long it for a day. I might be long it for 2 weeks. I might be long it for an hour. I had shorts on today, thankfully, in the Russell and the S&P. The S&P is going to close down 1.4%. The futures, at least, in a little bit, and the Russell's down 2.6%. We've had a short signal for 3 days in the Russell, and we're neutral in the S&P. So we had those trades on. I can tell you right now that those trades worked really well, and when we hit spots where we felt there should be support or there might be support, we started to cover and take profit. So we do trade the market, but I think the manic move and this manic like buy the dip and on the fringe, flying in, flying out. The memes on X are ridiculous. Like there's just too many people and too many people that should not be involved in committing capital and taking risk for their own sake are involved. And it's making it a little chaotic. To further the point, we had guys on today and they're well-known money managers that were talking about, how bad the market's broken. These are the same people that last week were talking about S&P 8,000. And then I look at the screen, I'm like, market's broken. We're down 80 basis points. Like, I don't know what you mean the market's broken. What do you expect this to go up literally? And it's almost like a Freudian slip where they expect it to be up every single day. Like when
Yes.
down 1% day is not broken. And I think that's a problem.
I think that's such a great read. And again, You have now a generation of folks who have never lived through that structural bear market, not a shock, like you
Mhm.
mentioned with COVID. That's such a great point, but they've never lived through that structural bear market. And so they do have this impression of anytime things go sideways, the Fed or the Treasury is going to step in and fix it, quote
Yeah.
unquote, right? And that's going to mean that we are just right back on the roller coaster. And yeah, so that's why under that model, yeah, it makes sense. You buy the dip. I mean, basically, these folks are just they're kind of just doing what they've learned.
Yeah.
It's eerily similar to I think what you saw in the 20s, at least not the first half of the 20s, but really just the last couple of years from like 26 to 29, where every time the market had a dip, you ended up seeing the Federal Reserve step in there as well. In previous years, you actually, people forget you had three business cycles in the 1920s. They were all pretty short, but they were there. So you
Mhm.
had several recessions during that decade. It wasn't like the Roaring Twenties was roaring the whole time, but the government was at least letting the market sort itself out. And then the last few years, the Fed, every time the market went down, it just stomped on the gas. And what
Yeah.
was the result?
Yeah.
Runaway commodity and equity prices until the Fed decided, what, we need to hit the brakes. They hit it a little too hard and a little too late, and that's how you get a stock market crash.
Yeah.
Now, I don't think you're going to like see something like that. I'm just saying that's the parallel there, right? It's the same kind of mechanism at play. When the market goes down, what happens? Well, again, the Fed or the Treasury makes some announcement. We're going to have some kind of intervention, and then off to the races again. So,
Yeah.
I mean, to a certain extent, you can't blame the retail investor, even though they're
No.
obviously what they're doing isn't right. It doesn't make sense. They're going to get burned in the long run when you do run into that bear market finally. But for the time being, I mean, it makes sense, right? Why they're doing what they're doing.
Yeah, and we also, I mean, to be, I'll talk about it quickly, and then I want to move back to this incestuous circle of spending. Um, the rally itself we've seen and has really been a structural rally, meaning it's not people so much chasing names because of valuations or chasing companies where expected cash flows year one, year two, year three out, 10 years out are at a level where we should expect a return. The expected return based on valuations right now for the market is zero over the next 10 years. That shows you where the market's at. The Schiller PE is at near an all-time high, only matched by 99 2000 bubble levels. So we've only been, I've said it before, we've only been above 40 twice. Once was heading into the bubble bursting in 99 2000, and
Mm-hmm.
now. So the structural rally we've seen has been really due to a lot of zero data expiration, derivatives, options trades, which are forcing the market makers to step in and forcing a gamma squeeze up. I'm not going to go into that in great detail right now, but essentially, because of derivatives being bought, which are zero data days to expiration, which are bets, they're not hedges out a month, a quarter, a year. They're not buying leaps out to January. They're buying options that are expiring today. They're creating an artificial demand for that supply by the market makers selling those options, and you're creating a massive squeeze up. That has been the crux of this rally. If you take out that product, that zero data expiration product, you would find that the VIX would probably be 10 points higher, and the rally would probably be half of what it is, if not the market flat or lower. And I do mean that. I do believe that 100% with all the other noise aside. EJ, the last thing I want to talk about with you, and this one I actually love, and I really want your take on it because I've spoken to a few people and I get mixed answers back. I get the jaw
Mm-hmm.
drop and like, I didn't realize that was going on. Or I get, yeah, that's the way it always is. That's the way it should be. It's new technology and these companies are building it together. But what this next chart shows is the transfer of capital between what I would refer to as a very incestuous group of AI and chip makers. So you
Mm-hmm.
have
Mm-hmm.
essentially, in my view, you have hardware, investment services, and venture capital all moving around and using the same dollars to mark sales, to mark gains, to mark investments, but they're literally being passed person to person, company to company in this one circle. And you have NVIDIA right in the middle with a $4.5 trillion spend and receive. By the way, I just saw today yesterday that NVIDIA has invested $2 to $4 billion in multiple companies. I think there were 4 or 5 companies there who are all NVIDIA clients. Now, I'm not suggesting there's anything nefarious going on. I'm just simply saying that if NVIDIA continues to invest tens of billions of dollars in customers of theirs who are going to turn around and buy chips, and then they're going to take the money and then turn around and invest in customers of theirs who are going to turn around and buy chips, like this is the incestuous circle we're talking about. This chart, this graph actually shows the flow of capital. Is this normally what we would see in a new technology in a group of companies, or is there something here where this dollar is being recycled and recycled and recycled and showing up in 20 places, but it's the same dollar?
Great question. Okay, so the first thing, and this is kind of the caveat before we get to, I think the real issue here. You do normally see this kind of vertical, it's a kind of vertical integration, I guess you can say, where these different companies at different stages working together. So that part is perfectly normal. What's not normal is the number one, the sheer size of it. And maybe you can excuse some of that away by saying, well, it's a new technology. We don't really have a base case for this. Okay, part of that makes sense, but not the way in which the same dollar is getting counted multiple times as it works its way through this supply chain, if you want to call it that. So it's one thing when, let's say, a company buys back their own stock, right? And that's going to obviously put upward pressure on that equity price.
Yeah.
But what we're seeing here is one company buying another and then using that to buy another and so on. And instead of seeing that reinvestment with retained earnings, you're seeing that investment, quote unquote, with borrowed money. And it's especially troubling when it's one company borrowing from another to invest in another. And it might not necessarily be one-to-one where it's company A is doing this with company B, but you have A, B, C, D, and now all of a sudden you have that loop. So it's the same thing, just with extra steps, I think it's fair to say. That's where you can look at this and say, all right, that's not normal.
Yeah.
And maybe even go so far as to say that's not okay from the investor standpoint, to look at this and say, the quote unquote earnings that I'm seeing here aren't even real.
Yeah. I think that's the concern. And I think really to wrap it up, I think that you put it well. I really don't have anything to add to that. I think when you wrap up the amount of credit, the amount of debt being written, when you wrap up the amount of money being spent out into the future for things that are not even built yet or not even working yet, and then when you wrap up the pass of the dollar at the levels we're talking about, I think we come to a place where, at a minimum, and this is kind of what I said last week with the market, with the potential to hit 7,500, 7,550 on the futures, which we did hit 7,540, as I said yesterday, and then down closing at 7,400, 7,420 today. I think at a minimum, what we've gone through today should suggest to people, take a look and take a breath. Understand what's underneath the hood and understand the game you're playing. If you want to ride the train, that's fine. It's fine. If they go from lower left to upper right and you're long, great. But understand the ride you're on. And my advice would not be, we know it's going to end bad, but you got to get on. That really is not what should happen, because you're never getting out when you should. You will hit the brick wall at some point. Mm-hmm. Be conscious of the risks that are there. There's a massive amount of credit, and it's an increasing, and I'm going to call it a bubble underneath. There's a massive amount of spend and assumptions out into the future, which may or may not be right. And we know they won't be perfectly right. So to your point, a change on the fringe, a 10% change, a 5% change, a 20% change in what those assumptions were, will absolutely cause this to collapse. And then you look at the way the dollars are being spent, and the dollars are being spent and somewhat recycled. There's a risk here. And I think that you nailed it with this flow chart. Definitely a risk here. Definitely something to keep your eyes on. So I would say be conscious of the train that you're on, because it is a dangerous ride for sure. And it always ends the same way.
Yeah, I mean, it's leverage at the end of the day, right? Like if we had to just boil this down into a single word, is that fair, do you think, Anthony, to say, like, look, what we're seeing here is just, it's an extreme kind of leverage. And it might not just be within one company, it's companies like working together to create that kind of leverage. But that's what it is at the end of the day, is leverage, and leverage equals risk.
That's right. And when used properly, it can equal returns. But the more leverage there is, the more risk. And I think that the leverage at this point is out of control. It's just out of bounds. So you're being rewarded now for that risk, but weeks, months, quarters of taking that risk and getting that return will be wiped out in days or hours because of that leverage. And it's a great way to put it. It's exactly what's going on. So thank you, EJ. Always a pleasure. Truly. I mean, this is real important stuff, because this is a market that potentially has a very big move coming, in my opinion, to the downside. We can continue to grind higher, but really appreciate your insight. There is a lot of risk here. I think we went through some good items and good data points as far as where the risk is coming from. And really appreciate your time. Really appreciate the insight as always.
You can find me on X at real EJ Antoni. And Anthony, you're CMT_Anthony, right?
That's right, at CMT_Anthony on X. And then the website is Ascalon6capital.com. So happy to chat if you hit me on X, and happy to see you guys checking out the website.
All right, Anthony, always a pleasure. Talk to you next week.
Take it easy, my friend.